Just give me a thumbs up if you can hear me. Awesome. So to start off with, big thanks to the Global Youth Economics Forum for having me, and obviously Lena for reaching out and for all the work that you're doing for the group and creating resources for students to spearhead their careers and their education in anything related to economics. So kudos to you, and welcome everybody from wherever you're joining today. As Lena said, my name is Mohammed Mazrehan. Can go by either my middle or first name, so whichever you'd like to refer to me as. And I am an associate trader at the Federal Reserve Bank of New York within the markets group, which we'll get a little bit deeper into what all that means. So before we do get started, definitely do want to put a disclaimer out there that the views at today's presentation are of mine and do not necessarily represent those of the Federal Reserve Bank of New York or the Federal Reserve system as a whole. So with that, let's get started. Alrighty, okay, my controls are working. So the Federal Reserve System. So let's walk back into the 1900s. The Federal Reserve System was founded by an act of Congress in 1913, and for the reason to be the central bank of the United States, and mainly for the purpose of creating a stable American banking system. The system overall consists of 12 Federal Reserve banks across the country, which are independently ran, and each of them oversee a jurisdiction in the region from where they're located. So to give you an example, the Federal Reserve Bank of New York covers New York State, northern New Jersey, southwestern Connecticut, as well as Puerto Rico and the U.S. Virgin Islands. So if you look at the map here, the map indicates the reserve banks by numbers, and we commonly refer to regions as districts. So we can refer to District 1 as Boston, District 2 being New York, District 3 being Philadelphia, and so forth, so on. So you can kind of see the lay of the land across the United States and where all the reserve banks are located. I'll pause actually really quick. Love to have this as interactive as possible. So if there's any questions that come up while I'm talking, feel free to unmute and chime in, question, concern, comments, whatever you want to. So we can make this definitely a dialogue. And I'll pause to ask some questions too. So make sure you're all ready on the unmute button to answer some questions. So with that, how the map really shows how the reserve banks are kind of spread across the United States, and represents which of the states have a reserve bank. What is not shown on the map is any satellite offices for the respective reserve banks. So, to give you an example, there can be a satellite office in New Orleans that not necessarily means that New Orleans has a reserve bank, but because they're a branch of another reserve bank located in a different state. So we'll notice there's a star in Washington, D.C., and the star represents the Federal Reserve Board of Governors, which is also commonly referred to as the board. And they reside in Washington, D.C., and is known as the governing body of the Federal Reserve System. So maybe just to pause here and see, has anybody maybe even visited a reserve bank in the States, or has gone to the boards or is familiar with the board? Maybe if just gauge an interest here.
Well, I personally haven't. Like, I've never like gone on to like a Federal Reserve Bank or anything, but I am looking forward to it in the future though.
Great, yeah. A lot of them do offer tours, and some of them have museums with educational pieces, so that can also be an avenue. Now, you may also heard of in the news the board being referenced, which will go into a bit deeper of the structure of the Federal Reserve System and what it all means when it comes to monetary policy. So that takes me to my next slide, which is the structure and responsibilities at the Federal Reserve System. So this illustration is pretty clean cut, and it shows how in the system we have three kind of key entities. And as we were just speaking of, the Federal Reserve Board of Governors, at the board, there are 7 governors that are nominated by the President of the United States. And each of these 7 governors serve a 14-year term. And then the board, or the head of the board, is led by the chair and the vice chair, which are also appointments by the president, but they only serve a 4-year term. Within the board, there's other functions and groups as well that reside underneath the governors and their objectives of what they're mandated to work on. We spoke about the 12 Federal Reserve Banks, how they're spread across the country, and each of them also have respective groups and functions and responsibilities, whether it's related to monetary policy, regulatory policy, community development, and other kind of supervisional or market-related objectives. And then we have what is called the Federal Open Market Committee. So y'all may have heard of the Federal Open Market Committee. It's also referred to as the FOMC. And this is a committee that is consisted of 12 members. Of the 12 members, 7 of them are the same governors that we just spoke about that are on the board of governors. Then there is the New York Fed president, and then 4 other Reserve Bank presidents that serve 1-year term each. Maybe I should backtrack. Each of the 12 Federal Reserve Banks across the nation have a president. So that's what I'm referring to as out of the 11, because New York Fed president will always serve on the committee by mandate. So out of the remaining 11 banks, 4 of the reserve banks get a 1-year term into the committee. And the FOMC creates and establishes the nation's monetary policy, which is kind of what we'll be focusing on in the later half of the presentation. So now, kind of 5 main key functions, if you will, and responsibilities. First is, as we just said, conducting the nation's monetary policy. There's a dual mandate, so a dual responsibility that the FOMC has for monetary policy, which is to promote maximum employment and stable prices in the US economy. So maybe I just want to pause here and ask the audience, what does that really mean to them when they hear monetary policy and the FOMC has a dual mandate of maximum employment and stable prices in the US economy? Don't be shy. There's no, you're not going to be graded or anything. So more to just kind of get the brains going on a Sunday afternoon.
Hello.
How you doing? And if you can name and where you're from would be great.
My name is Samuel Kikwesi. I'm from Ghana. My understanding of the question is basically seek to it that inflation is controlled in order to ensure employment growth.
Great. I heard inflation for sure. Yep. So these are all factors that can impact prices, right? Stable pricing, and can impact overall employment or the unemployment rate. Thank you. Next, we're jumping into promoting financial system stability. So the Fed monitors financial system risk and engages at home and abroad to help ensure the system supports a healthy economy for US households, communities, and businesses. Next, we have supervising and regulating financial institutions and their activities. The Federal Reserve promotes the safety and the soundness of individual financial institutions and monitors their impact on the financial system as a whole. So maybe to pause there if 2 and 3, if someone wants to give maybe a recent example of what we may have seen in the US economy that can be correlated to these two key functions. So I'm thinking the recent banking crisis that we had with SVB and Signature Bank. So 4 is fostering payment and settlement system safety and efficiently. The Fed works to promote a safe and efficient and accessible system for the US dollar transaction. And this is kind of impacts all of us on a day-to-day, right? This is our transactions, whether that's us going to the grocery store, swiping our credit card, using Apple payments of any sort, any recurring, any payrolls. So this has to do with the entire system of settling payments and having payments kind of transact. And then lastly, promoting consumer protection and community development. So the Fed advances supervision, community reinvestment, and research to improve understanding of the impacts of financial services, policies, and practices on consumers and communities. So maybe just pause there before I do move on. If anyone has a question on what any specifics of the structure and the responsibility that the Federal Reserve System as a whole has, or any of the specific entities. Great. So now we spoke about these responsibilities, right? And how they kind of are broad plate. But we're gonna really focus more so on monetary policy, who conducts it, and really kind of what it is and how it is used essentially, or what the tools are to be used. So let's walk into who conducts monetary policy. So we understand from the previous slides that the FOMC establishes monetary policy. And when I say they establish it, there are 8 times the FOMC meets during a year. And this is when they are talking about market developments, the soundness and safety of the financial system, topics on inflation, topics on employment, to think about how monetary policy should be created in the interim period, which is when, if you turn on the news, you may hear that the FOMC committee has created a certain type of policy, or the Federal Reserve has raised interest rates, for example. So this is the same establishment of monetary policy that I'm talking about. So once the FOMC creates or establishes monetary policy, it is now put into play by the markets group, specifically known as the desk at the Federal Reserve Bank of New York, which were the ones that are actually implementing the policy that was just established. So let's now walk into the New York Fed, where I work downtown in Manhattan. And within the bank, so I'll refer to the bank, I'll refer to the New York Fed or the Federal Reserve Bank of New York as the bank. So these are all just interchangeable words. So at the bank, there is a group or a function called the markets group, among many other functions and groups, and we have a slew of responsibilities. And the area within the markets group that implements monetary policy is referred to as the trading desk, or more commonly known as just the desk. So you can read pieces and it will refer to the desk, and that will be referred to as a trading desk at the New York Fed. Now, to implement the policy, it's done by trading securities in the domestic and international markets with private sector counterparties, which you hear referred to as open market operations. And this can be products like treasury securities, mortgage-backed securities, foreign exchange, etc. And on the slide, it shows obviously the markets group's mission and what we are striving for, and then also the different parts within the markets group that not necessarily are the desk, but also have other responsibilities like lending services, monitoring and analyzing both domestic and international financial markets and their macro trends, whether that's account services or debt financing or treasury debt management. So I'll pause there before I do move on. If anyone has questions on, how we went from the Federal Reserve System as a whole to the board to the FOMC committee. FOMC committee establishes monetary policy, and now to put that policy into play, now we're at the New York Fed at the markets group. So before we do jump into a bit more of what monetary policy is and the tools, I'll pause and open up for any questions. So I see a hand, Eugen?
So I have a question about not what you've discussed before, but about like the reference rates. So why was there a transition from LIBOR to SOFR? Is that what was the rationale? Is that what was different from like the two between the reference rates?
Sure. So maybe we can get into reference rates during the Q&A if you don't mind. So maybe we could shelf that question. But I appreciate that question and very important as well. But maybe if anything on just like the structure of the Federal Reserve and who implements the policy essentially. Great, so let me move on. So let's talk about federal funds rate. So the federal funds rate is the interest rate at which depository institutions trade federal funds, which are balances held at the Federal Reserve Bank, with each other overnight. So in simpler terms, if we have two banks, Bank A has excess cash, which is often referred to as its liquidity, and Bank B needs to quickly raise liquidity, and that could be for a number of reasons like overnight deposits, payroll, etc. So Bank A will lend its excess cash to Bank B. The rate that the borrowing institution, which is Bank B in this scenario, pays to the lending institution, which is Bank A, is determined by the two banks. The weighted average rate for all of these types of negotiations is called the effective federal funds rate. And the effective federal funds rate is essentially determined by the market, but it's influenced by the Federal Reserve through open market operations to reach this federal funds rate target. So when the FOMC meets, you may hear in the news that the committee established a new target range for the federal funds rate. And maybe if anybody knows what the current rate or the target rate range is, you can just unmute and shout it out if you want. So currently we're at 4.75 to 5%. And in the figure that is on the slide, it shows that the upper bound in red and the lower bound in blue of the federal funds target range since 2015, as being displayed here. We see the range is increasing in 2018 as kind of job market was strengthening and inflation was moving towards a 2% rate. You see that much of the decade before, then the inflation rate was below 2%. In March 2020, you'll see this gray tripwire here, which is COVID-19 hitting the economy. And the FOMC quickly moved the target range down to near zero to support economic activity. Which is why you see the big dip into the graph there. So the Fed implements monetary policy by using its policy tools to ensure that the federal funds rate stays within the range, which is displayed in black. So talking about policy tools, we'll next dig into kind of the different tools we have to establish monetary policy. Before we do move on, one of the axis is labeled as basis points. So just wanted to gauge if anybody can answer what a basis point is, or it's also referred to as BIPs.
So from my understanding, basis point, it's like measures, for instance, like if you see 500 basis point, it's like it translates to basically 5% in terms of rate. So 1 basis point will translate to 0.01%.
So definitionally, a basis point is 1/100th of 1%, right? So this is used to express commonly the difference in interest rates. So maybe another example is if we're talking about 25 basis points, that equals to 0.25%. Good. Anybody have any questions on just the chart of the effective federal funds rate and the upper and lower bound of the target range? We'll get a little bit more into details here. Great. So next, let's jump into the tools that monetary policy has. And essentially, these tools, the first 3 tools that I'm going to talk about are more so on the demand side of the supply-demand curve. And the first one we're going to talk about is the discount window rate. So the discount window, it's a rate that is established by the Federal Reserve, obviously, which is the rate that the Fed charges when lending money to banks. And this sets a ceiling to the federal funds rate that we spoke about previously. And this tool plays an important role in supporting both the liquidity and stability of the banking system. The discount window provides access to funds and helps depository institutions manage their overall liquidity risk efficiently, and avoids actions that have negative consequences for their customers, such as wide withdrawing of credit during times of market stress. Thus, the discount window supports a smooth flow of credit to households and businesses. Can anybody maybe think of a recent example of when the discount window was largely used. So after recent developments of Silicon Valley Bank and Signature Bank, the Federal Reserve System opened up the discount windows and changed some of the lending requirements to create other institutions or help other institutions to have that smooth flow of credit to them and having access to funding, as it was a time of heightened stress into the market, and this was an avenue for them to have these loans available to them if needed in a liquidity risk scenario. Any questions on tool 1? Great. So let's jump on to tool number 2, which is known as the interest on reserve balances. So interest on reserve balances can also be referred to as IORB. And this is the interest rate that the Federal Reserve pays on reserve balances to eligible institutions that keep their reserves at the Federal Reserve Bank. So another question there, who can tell me what a reserve is? Or what does it mean when a institution has reserves at the Federal Reserve Bank?
Hello. My understanding of reserve is like when banks are statutorily required to keep some balances at the bank, at the Federal Reserve. So those are the reserves. Perfect.
Yeah, exactly. So the eligible institutions have a mandate to hold reserve requirements at the Federal Reserve Bank. And this is what we're referring to as the Federal Reserve paying interest on those reserves to those institutions. So the IORB is also known as the primary tool the Federal Reserve uses to implement monetary policy. And this rate is considered to be the floor of the federal funds target range. By having the IORB, the Fed can control how much reserves to require from banks at a given time. So maybe also just a little extra note there, depository institutions have kind of little incentives to lend in the overnight interbank federal funds market at rates below the interest rate on excess reserves. So I'll pause there if anybody has any questions on just IORB in general. Great, moving on then to the next slide. Tool number 3 here is overnight reverse repurchase agreement, also known as, we love our acronyms at the Fed, O and RRP. So institutions agree to buy a treasury security from the Fed and then sell it back the next day. So in return, the Fed pays that institution the overnight reverse repurchase rate. So this is equivalent to the financial institutions depositing cash at the Fed and the Fed giving them a treasury security as collateral, paying them overnight reverse repurchase rate on deposits and agreeing to buy back that security the next day. So this facility is particularly important for monetary policy implementation in periods when reserves are elevated. As reserves grow, banks' willingness to take on additional reserves kind of diminish, and they've reduced the rates they pay for deposits and other funding. And in this environment, market rates trade below IORB rate because of non-bank lenders and willing to lend at such rates. And to maybe give you a bit more granular detail about this is Federal Home Loan Banks, which are known as FHLBs, which are important lenders in the Fed funds market, are not eligible to earn IORB, but are willing to lend at rates below the IORB rate rather than leaving funds, in their accounts at the Fed. So to provide that floor under the federal funds rate, the FOMC introduced this ONRRP facility. And I'll pause there before going into the last tool. Great. So tool number 4, which is the open market operations. And here we're talking about now the supply side of that supply demand curve that I started the conversation with. And by conducting open market operations, the Fed is buying and selling securities like US Treasuries and mortgage-backed securities, which shifts the reserves in the system. So when the Fed purchases securities, it pays for them by depositing cash into appropriate banks, reserve balance accounts, adding to the overall level of reserve, aka the cash in the banking system. So during COVID-19, an increase of the Fed's balance sheet took place as the Fed started to purchase securities to inject liquidity into the market. And the effect of purchasing securities was to reduce kind of longer term interest rates and to support the economy. So the expansion of a Fed's balance sheet is known as quantitative easing, which you may have heard of as QE. And when QE ends, or when QE ended, the Fed reinvested any of the maturing securities that it held to maintain the size of the balance sheet. Now the Fed is fighting inflation by raising interest rates, or the interest rate target range, and in the process is shrinking the Fed's balance sheet, which is referred to as quantitative tightening, also known as QT. By passively stopping the reinvestment in some maturing Treasury securities and agency mortgage-backed securities, which is the desk that I currently sit on. So maybe I'll pause there. If anybody has any questions on any of the tools that we spoke about, or specifically on open market operations. Go ahead.
So I watched a documentary about the financial crisis that happened around 2007, 2008, and they mentioned that mortgage-backed securities were part of the causes of the crisis. And I would like to find out what is different from these mortgage-backed securities that the Feds are trading now from those that was alleged that it caused the financial crisis.
Sure, definitely. Great question. And I'm going to also shelf that for the Q&A, because it can turn into a longer discussion. And I noted that, so we'll get right back to that in the Q&A, which I'm almost done over here, so we can jump into it. Any other questions before I do move on? Great. So lastly here, just a quick slide on monetary policy implementation, to give you some numbers to have as a perspective. In 2022, the New York Fed did over 1,000 open market operations, which equal to close to $500 trillion, 883 international operations that equated to about $410 billion, 33 Treasury securities purchased over the year of $9 billion, 269 MBS purchases, $1 billion of MBS purchases operations, which were reinvested as $239 billion. And then 231 reverse repo operations that equated to close to $455 trillion. So those are large numbers. And it kind of comes to show of how in a time of crisis, the balance sheet and how open market operations really does shift between QE and QT. So I just thought that was a really neat illustration to kind of just see what it really means when the Fed is purchasing or selling or interacting in open market operations. What does that really mean in terms of a dollar amount, and how does that really impact the system? And then lastly, I just have a couple of resources here, and because this was introduction to the Federal Reserve System as a whole, it can be very confusing, I guess, because there's a lot of moving parts and a lot of different factors of who does what and how, essentially what we like to call it, how the sausage is made, and the different nuances of monetary policy. I mean, we can go deeper into the specific tools and the different implications of monetary policy and why we're doing or not doing certain aspects. I think these are really good resources if you wanted to take away or to even just continuously be present and aware of where the monetary policy is going and the decisions that are being made. Liberty Street Economics on the Federal Reserve Bank of New York's website is a great resource where economists publish papers and special topics. Also, a number of Federal Reserve websites, but specifically I would say the St. Louis Fed, the New York Fed, and the Board of Governors website is very helpful for not only different topics, but also understanding if an operation happened, all that information becomes public, and then you can see what operation took place on that day, of how much, and of what actual security. So that's really neat to have that access and to see it kind of real time. And then I thought some interesting book recommendations that really paint a really good picture of the Federal Reserve System, how it came about historically, historic crisis that took place, and how the Fed went to call for action, and maybe some pros and cons in the process of it. So America's Bank, that big struggle of creating the Federal Reserve, it's a great book to understand just how the institution was created and what was the purpose of it, and the nuances that were given. Keeping at It is a great book by Paul Volcker, and it starts off great when it is showcasing his early life as a child, growing up, and how econ was around him, and how he made decisions to kind of make it his career, and then eventually being a Federal Reserve senior leader, obviously, and it gives a really good picture of the markets group and New York Fed and the Federal Reserve System as a whole. Stress Tests is a great book by Tim Geithner, talking about the financial crisis and the response to the financial crisis back in 2008. And Limitless, the Federal Reserve takes on a new age of crisis, is more recent and relevant to the COVID-19 pandemic and the impact that it created to the economy. So I know summer's around the corner. Some of you might be graduating, so maybe add it on to your beach reading list. And surprisingly, they're pretty fascinating books. So they'll definitely keep you entertained. I will say if I can suggest, Stress Test is great as an audiobook if you're looking for an audiobook, because it is narrated by Tim Geithner himself. And I will pause there. And I guess now we can open it up to Q&A. And Lena, maybe if you want to stop recording at this time.